Warning, the UK debt crisis is accelerating at an alarming pace. The latest budget report just came out showing the deficit exploded much higher than expected, intensifying fears of a full blown debt crisis and debt doom loop. Worse yet, the bond market continues to melt down, sending interest costs soaring and a textbook debt spiral developing. Let's take a look. So, monthly budget report came in much worse than expected for the UK, much like the US. We can see came in 18 billion pounds. Expectation was for 12 billion pounds. Now, again, with budgets, you should look month to month because some months you will get a spike in revenue, tax season, for example. So, looking at other August, we can see that this is the highest deficit, the worst deficit, going all the way back to August of 2020. There was kind of a lot going on in August of 2020, as you might recall. The fact that the deficit is almost as bad as August of 2020 is certainly notable. Now, this is also 50% higher than was expected. Expectation was 12 billion and it came in 18 billion pounds. Now, not only that, it gets worse. The deficit grew 24% on a year over year basis. We will see the implications that that has. Arguably, the UK is in a debt doom loop or a debt spiral. And we will go through the video, explain what that is, show why it is happening and how it is happening. But if you are not familiar with that concept, if you haven't heard about it before, very briefly, a higher deficit, like we're seeing, means more bonds must be issued in order to fund that deficit, right? That is how they raise money to fund a deficit, is by issuing bonds. Well, more bond supply equals lower bond value. And remember, bonds have inverse rates or yields to the bond value. So a lower bond value because more bonds are being issued, more bond supply, that means higher rates. Well, higher rates equal higher interest expense. Higher interest expense means a higher deficit. Higher deficit equals more bond supply equals higher rates, and on and on and on. This is why there are serious talks about an IMF bailout, not only in the UK, but also in France as well. That is just one of many articles that I've seen recently about an IMF bailout for the UK. Here's spending as a share of GDP. This is only final consumption expenditure plus interest. And then revenue as a share of GDP. What we can see 25% for revenue and spending, again, not total spending, just FCE plus interest, running at about 38%. So both of these are higher than, say, in the US. Here's a Bloomberg article that goes through a number of the metrics we just went over. Here you can see that the deficit is outgrowing the expectations. What I want to point to is the UK, this has been developing for many years, and the UK has made it clear their approach is going to be to raise taxes. Well, there's a number of problems with that that we will see reflected in some of the charts later on. Number one, you have millionaires and billionaires, then the ultra wealthy, they flee. They just go to Andorra or somewhere with low taxes and they flee. So your taxable base actually shrinks and it actually hurts revenue. Remember, the deficit is the difference between revenue and spending. So if you're decreasing your taxable base and decreasing revenue by raising taxes, you're doing the exact opposite thing of what you're trying to accomplish. You're making the debt crisis worse. Number one. Number two, taxes by definition are negative for growth. And as we will see later on, debt crises are really just growth crises, and that is negative for growth. So tariffs, by the way, are also a tax, and they will be disinflationary for that reason because they constrain consumption, they reduce consumption. It is targeting the demand side. If you weren't taxed at 33% of your income, you could have that income to then go spend on movie tickets and a new car, whatever you want to buy, right? So hopefully it is clear how taxes can actually make the situation worse when you are in a debt crisis, because not only do the wealthy who pay the majority of the tax, not only do they flee, but you also have a constraint on growth. And as we will see, that is really what debt crises are really about. So here we can see the short-term reaction from the bond market and the currency market. We can see the pound versus the dollar. The pound weakened when this budget came out, weakened quite notably. And the 30-year minus the 2-year yield, that spiked, meaning a steeper yield curve. And we'll take a look at the yield curve in a second. But zooming out, here's how we got there. Debt crises do not happen overnight, they develop over time. We can see that back in the 70s, there was actually another IMF bailout for the UK. Well, as part of the bailout, as is normal, as is custom, they demanded austerity. What does that mean? That means that you must cut spending, cut benefits like social benefits, for example, and raise taxes. Well, sure enough, that worked to bring the deficit down from about 6% of GDP down to about balanced budget. However, look at what it did to unemployment. And we can see, of course, inflation was also a concern during this era at about 15%. So very, very high inflation. Of course, that was going on in the US as well, with the supply shocks, with oil embargoes and all of that. But in kind of recent history, we can see the same story for the US, a pro-cyclical deficit, meaning the deficit has gone from a 1% surplus to actually a 6% of GDP deficit. This is not the most current data. We'll take a look at that in a second. 6% of GDP is insane, even for the US. And the US is the global reserve currency issuer of the world. 6% for the UK, who is not the global reserve currency, is even more insane. So it's already pretty crazy for the US to be running that large of a deficit outside of a world war or a major recession. It is even more crazy for the UK to be running that sort of deficit. And again, pro-cyclical because there's no recession and unemployment is actually down over the past 25 years. And despite that, the deficit has increased or worsened by 7 percentage points just as a share of GDP just in the past 25 years. Here, again, remember with debt and debt to GDP, it is possible for Western, and this is what Western governments have done kind of naively, is they have taken on more and more debt. Their debt growth has outpaced their GDP, which is why US debt divided by GDP is going up and to the right. They are taking on more debt than they are getting in GDP. Well, that works out so long as the cost of that debt, the interest rate on that debt, is going down because you're in a secular bond bull market where rates are coming down. You can take on more and more debt. And sure enough, that is what Western governments have done, kind of delaying, kicking the can down the road and hoping, pulling the future forward, as the phrase goes. The only problem with this, and of course, also the case for the UK as well, the 15-year, which by the way, their average maturity for all of their marketable debt is about 15 years. So that's why we're looking at that yield here. We can see it's been down. So they've been able to take on more and more debt going back the past to the mid 90s. They've been able to take on more and more debt. Well, this works until yields do that. And of course, we are out of, we have exited the secular bond bull market where rates are falling. We've clearly broken out of that, multi-decade trend of a bond bull market and are in a different era. And if you thought yields looked bad in the US, just look at what yields look like in the UK. This is their 15-year gilt yield. Now, here's zooming in a bit more with more current data. You have to use a bit of a complex formula to actually get this, but we can see that the deficit has gone from about 4.5% just a year ago to 6%. Again, remember, on a fiscal year 24 to fiscal year 25, the deficit is growing 24% on a year-over-year basis. This is absolutely crazy. And unemployment is rising, right? But they are not in a full-blown recession. It's more of a stagflation sort of environment. Well, what is driving the difference between spending and revenue? Is it revenue or is it spending? Well, it's actually both. So government spending, again, final consumption expenditure plus interest. Interest is really what is driving government spending much, much, much higher. So if we look just about in 2021, in early part of 2021, government spending, again, including interest expense, was running at about 435 billion pounds. Now it is running at about 652 billion pounds. That measurement only works for the underlying chart. So can't see a percentage increase, but that is a 75% increase in government spending once you include interest. And again, interest is a major component of what is driving government spending. But as if that wasn't bad enough, you have a dip in revenue. And again, they've been trying to tax their way out of this for the past couple years, and millionaires are fleeing. I think something like 60 millionaires fled the country last year alone. You have this massive kind of capital flight. And this is part of the reason the pound has been weakening, generally speaking, and yields have been moving higher, is that those millionaires and billionaires are selling their pound denominated assets. And that is putting downward pressure on the pound, putting downward pressure on the stock market, downward pressure on bonds, upward pressure on rates. So you have revenue actually going down as a share of GDP from 28% back here in 2023. That was the peak, down to 25%. And this is despite the fact that they've been raising the tax rates. So again, when you're in a debt crisis, raising taxes actually makes the situation even worse. As we could see, revenue as a share of GDP is actually declining. So here's what annual government spending or final consumption expenditure. Here's what is included in that. If you would like to pause the video and read more about that, but we can see that spending here, we should be able to take a measurement. From June of 2020, spending has increased by 64%. If we go back to right before 2020, in 2019, spending is up about 32%. And again, this chart does not include interest. What is really driving this government spending and the deficit is interest. So let's look at the bond market. Well, before we look at what it's doing now, we should look at the last time that they really had kind of a fiscal crisis. And we don't have to go very far back to see one. This was the Liz Truss moment where she announced a mini budget that was going to blow out the deficit. And initially, the pink line shows the 30 minus the 2, so the spread between those two yields. Initially, you got a flattening of the yield curve. You actually got an inverted yield curve. But then what happened? Some degree of forced selling of long-term gilts started to occur. So you got a rapid bear steepener where it went from a 43 basis point inversion where the short-term rate was higher all the way up to an 84 basis point spread. So that is a significant swing in a very, very short amount of time. I mean, we are talking just a couple weeks here from start to finish for this. Now, eventually, the bear flattener, by the way, that is in anticipation of kind of central bank tightening, right? Rate hikes to control inflation. So initially, the bond market was saying, hey, this is going to be very inflationary. We know that inflation's already kind of hot, so the central bank will have to raise rates. So you got a bear flattening initially here, but then you really got kind of a steepening of the yield curve. Remember, steeper yield curve or bear steepener, what that indicates is long-term fiscal concerns, long-term inflation concerns, because again, convexity is present with these longer maturities, say a 30-year bond. Convexity makes each percentage point of inflation that much more painful for you because you bought a 30-year bond. So every year of 1% higher inflation eats away at more and more versus, say, something like if you had bought a 1-year government bond. Well, if inflation comes in a bit higher, you only lose money for 1 year. And of course, it's 30 years if you buy a 30-year gilt. So that is what that bear steepening indicates. So hopefully that is clear. And then here, if we zoom forward to kind of what is going on presently, here we can see that the yield curve has been steepening, much like the US, since the central bank started to hike rates. This is generally speaking outside of the 3-month and the 1 year, so the short end of the curve. Outside of the very short end of the curve, this is a bear steepener. What this means is rates are going up, but long-term rates are going up the fastest. This is what you see when the bond market is worried about inflation, when they are worried about further bond supply, right? Larger deficits in the future. This is a sign of fiscal unhealthiness, I guess you could say. And that is what we have seen since the central bank started to hike rates. We can see that the 30-year gilt yield has actually gone up, much like in the US. Now, inflation, it's important to point out, inflation is running at 3.8%. That is basically the same yield as the 3-month or the 1 year or the 2 year. So the short end of the yield curve is basically right at the inflation rate. meaning that to get inflation from 3.8% down to a more healthy, say, 1.5%, 2%, they would have to hike rates. Well, if they hike rates, that would blow out the interest expense, which again means higher deficit. Higher deficit equals more bond supply. More bond supply equals higher rates, and on and on and on, at least at the long end of the yield curve, unless you're doing QE or yield curve control. But we'll get to that in a second. So the yield curve has been steepening. It's a bear steepener. This indicates fiscal concerns, long-term, worries about future deficits going up, increasing, getting larger, and future inflation. And of course, the bear steepener is even more pronounced than in the US. If you thought the US yield curve looked bad, it's even worse in the UK or France or Germany, as we'll see towards the end of the video. We have a weight it gets worse at the end of the video. So here's government spending, full government spending as a share of GDP, 44%, and then interest expense, just interest expense per year. And what we can see is that just over the past year or so, interest expense, if I can take a measurement here, interest expense has gone from about 75 billion all the way up to about 95 billion pounds per year. That is an increase of 28%. So we established that the deficit is growing at 24% on a year over year basis. Well, a large component of that is interest expense. And once we start to include the deficit here, you can hopefully see the kind of correlation between all of these. But interest expense is really what is driving this picture. If we go back to the bond market, it's because yields are going higher. Now, short-term rates are coming down. But again, if you issue your debt at short-term in short-term instruments, they are more cash-like, they're more liquid. It is more stimulatory, more inflationary, and you are removing central bank independence because if you're rolling your debt every 3 months, because all your debt is in 3-month bills, you can't hike rates ever. Because if inflation comes around and you can't hike rates, because if you do, then you blow out interest expense because you're rolling your debt every 3 months because you've issued all of your debt in short-term bills. So there are a number of consequences with the kind of, well, we'll just cut the short-term rate, cut the overnight rate, and then issue all of the debt in short-term bills. There are major consequences to that approach. So here we can see interest is really what is driving the story up about 28%. But of course, debt crises are really growth crises. If we look at real GDP, this is inflation adjusted growth since 2008. It is 1.5%. So it is not very good in the US either, of course. We always point this out with the silent depression work, but it is even worse in the UK, only 1.5%. In fact, on a per capita basis, it's only like 0.2% since 2008. So growth has been very, very poor for the UK and most Western governments. Now, here we can see the cost of the debt. Now, remember, if you are a government, it might be very painful for your people. But if you have very low growth, and we can see that growth is decelerating, we can see that growth has been falling from an already low 1.5% down to just 1.2% over the past couple quarters. Not only do you have that, but you have inflation going up. And again, 3.8%. Well, remember, nominal growth is really, as a government, what they care about. So, this is textbook stagflation, right? Falling growth, 1.2%, very low, and high inflation, 3.8%. That is textbook stagflation. That is horrible for the average citizen. However, if you're the government, this is what you really care about, nominal growth. And that is just inflation plus real growth. Now, the break even to get the debt under control is 6.5% nominal growth. Well, they are well below that at just 5%. Now, one of the ways you can get to 6.5 is to run it hot, right? And have inflation go from 3.8% up to 6.8%. That would get your nominal growth up. Now, it'd be very painful for your people. But if you're in a debt crisis and you're the government, you really only care about nominal growth, nominal GDP, and inflation is one of the ways you can get there. Now, again, remember that long-term bond yields approximate nominal growth expectations over the future. Now, of course, included in there is a risk, a term premium or risk premium for taking duration risk and the convexity that we mentioned before. So there it is nominal growth expectations, which is real growth plus inflation, plus concern, if there are any concerns about deficits going up, because remember that means bond supply will go up. So if there's concerns about ever rising deficits, that would get baked into the long term yields. Well, here we can see that long term rates right now, 5.1%, at least for the 15-year, and nominal growth is below that at 5%. Now, again, remember, the bond market doesn't want to lose money. And so, generally speaking, it is not it is not natural for the bond market to demand a lower interest rate than nominal growth. Again, generally speaking, over time, the bond yield approximates nominal growth. Well, here we can see the spread between the 15-year yield, or the cost of the debt, versus nominal growth. And what we can see is, again, has been positive, meaning this is when the interest burden, this is when the debt gets more burdensome, is when the cost of the debt is above nominal growth. Now, generally, the bond market does not want to do this. The way that that happened was the Bank of England balance sheet expanded. So I'm not sure if this is not going to pull up, but Bank of England balance sheet after 2008, just like in the US, of course, they were engaging quantitative easing, where they are printing bank reserves to buy bonds. And sure enough, just like in the US, most Western governments were doing that. Well, that was able to get the cost of the debt, the yield or the interest rate, that was able to get it below nominal growth. And again, that gives you some breathing room. But again, that is inflationary. You are printing money to buy treasuries, or in this case, gilts, mortgage-backed securities. You are buying assets from banks and giving them freshly printed money. It is inflationary. It is stimulatory, at least, especially so with asset inflation. QE is more of an asset inflation story than it is really a consumer price inflation story. But this is probably one of the paths that we might likely see, is a return to QE to get rates down. Because again, if you can get rates down and you can get your nominal growth up, then everything is okay, generally speaking. Again, remember, the main thing that is driving government spending is the interest. And so if you can get nominal growth up, again, via inflation, right? Because that helps actually for nominal growth. If you can get that higher, and again, that is basically what's been happening over the past couple of years. You have 3.8% inflation and only 1.2% growth. For the government, it doesn't really matter. Now, it's very painful for the people, but this is one of the approaches. This is the approach, by the way, the US is trying to take. Run it hot, run nominal growth above the cost of the debt. But again, the bond market doesn't want to naturally allow that to happen. So you have to force it to happen. Now, why all of this matters is, here we can see the tick data. These are the largest holders of US debt. And we went from very, very strong economies like Japan and China that run current account or trade surpluses. We went from them being our major creditors. Well, now the United Kingdom is the second largest holder of our debt, with $900 billion of US Treasury debt that they could sell to finance either of the two deficits, whether it be the fiscal deficit or the current account deficit, which, by the way, is also quite large for a country of their stature. Because again, remember, they import most of their energy. When you run a current account deficit, by definition, you're generally running a trade deficit. And your people need meds from the rest of the world. Your people need clothing from the rest of the world. Your people need energy, especially for Europe. And so you have to finance those deficits with what you can, and that you sell what you can, not what you want to. Well, they own $900 billion of US Treasuries that theoretically they could sell to help finance either one or both of their deficits. But now, wait, it gets even worse. So Germany, also on the 18th, we got data from Germany. Their deficit, they're going to borrow about 20% more than had been planned for the fourth quarter. And again, this is due to a surge in spending on infrastructure and defense. But Germany announced their deficit is going up by 20%. UK is arguably in a worse spot from all the various metrics I've looked at. France and the UK are arguably in a debt crisis. Again, this is how that debt doom loop actually works. And hopefully that was helpful. Remember, it is mainly being driven by government spending. Government spending is mainly being driven by interest expense. As we can see here, interest expense is being driven by higher bond yields. So this is really the problem they've got themselves in. You can't just raise taxes and tax your way out of it. As we can see, that's actually going the opposite direction over the past 2 or 3 years. And again, it hurts growth. So you really you want to do things that boost growth to a degree above and beyond which the cost of your debt is growing, both in terms of interest and the annual year-over-year deficit increase. So, anyways, hopefully that was helpful, and I will catch you in the next one.